Welcome back. We got a good rally underway this morning in stocks after NVIDIA's strong earnings report and its forecast for the next quarter reignites the AI trade. Check it out. Dow Industrials right now up almost 300. The NASDAQ is up 453 points. We are going to see a rock and roll opening this morning with tech once again in the lead across the board. Stocks are higher. Yields this morning, meanwhile, are also higher. Take a look at this. The yield on the 10-year is up 1.1 basis points. It is sitting at a level of 4.15% ahead of the highly anticipated September jobs report, which is out in 12 minutes. We are on countdown mode now. Economists are expecting 50,000 jobs created for the month of September, with the unemployment rate holding at 4.3%. Now, the Bureau of Labor Statistics has canceled the October jobs report, saying that it could not collect enough household data during the record-long shutdown, 43 days. It will instead incorporate those payroll numbers into the November report, which will be out after the Federal Reserve's final meeting of the year. So this report today is the last meeting before the Fed meeting. This is the last jobs report before the Fed meeting. The BLS is going to report the monthly jobs numbers coming up. Joining me now ahead of all of that is Macromavens President Stephanie Pomboy. Stephanie, good to see you. Thank you so much for being here. It's hard to make predictions when you don't have the household data, and you've been focused on the household data this whole time.
Yeah, I mean, it was sending you a very different signal from the payroll data. And I think that that has been important. And obviously, we are really flying blind without it. It was a much better indicator than the payroll survey has been. And that's because at turning points in the economy, the household survey is a much more accurate reading because it's actually a survey of people rather than a collection of these payroll data that then is run through this statistical massage factory where they impute the number of jobs created by new businesses. And basically, they just pull that number out of thin air, for lack of a better explanation. And so when the economy starts to slow, they're still imputing big job creation by new business startups that aren't happening. And in a year like this, where we've seen this parade of corporate bankruptcies with businesses closing faster than they're opening, that creates a really large distortion, as we saw with the dramatic revisions on that payroll number. But clearly, you know, the trend here is towards slower employment growth. We've seen a huge increase in layoff announcements. The University of Michigan consumer sentiment reading, which tends to lead the actual unemployment rate, has been reflecting very, very dour sentiment about the labor market particularly. And then, of course, like the small business survey also has seen a sort of steady and continued slowing of hiring plans. So all of that suggests whatever the number is today for September, it will be weaker than that when we do get those readings for October and November at the end of the year.
So, Stephanie, what is most important for us to look at when we start zeroing in on these numbers? We're about to get the jobs numbers out for the month of September. What specific metrics within the overall report are you going to be focused on?
Well, I'm going to be looking at wage growth, obviously. I think we've seen a clear deceleration in inflation. And the hope, obviously, is that if wages can just hold steady while inflation slows, then real income growth can accelerate, which would provide some relief to households. And obviously, you know, we want to look at where the job growth is coming from. But again, this is such stale data at this point, and the indicators we've seen in the ensuing weeks suggest that we're continuing to see a real slowdown here. I would look maybe less at this September report and more at the unemployment claims data that will be released at the same time, which is obviously much more timely to get a real-time indicator as to what's going on with employment.
Yeah. But at the same time, look, this is going to be the last report before the Fed meeting in December, and you had Fed Governor Stephen Miron calling for a full reset of the post-crisis banking rules. He's warning that more than a decade of tightening is pushing traditional lending into the shadow banking system. You know that better than anybody. He's arguing for exempting treasuries from the leverage ratio, rewriting key capital measures, saying the current framework discourages banks from holding low-risk assets, and it's hurting the treasury market liquidity. Myron also said that credit allocation should be driven by market forces, not regulatory profiting from price differences. By the way, I'll be speaking with Governor Stephen Miron this coming Tuesday, so join us for this interview coming up next week. But what are your thoughts about how this report that's coming out in 7 minutes is going to impact what the Fed does in December?
Well, I mean, I think that he is correct that the Fed has gotten it wrong every time. You know, over the last couple of years, they've turned right when they should turn left. And I appreciate the fact that he's focused on what is the key issue for the Fed and the economy and the financial markets, and that is getting the long end of the Treasury curve down. So far, the Fed has cut rates to no benefit. You know, the 10-year yield is actually modestly higher than it was when they first cut rates in September 17th. So this SLR tweak that he has proposed is really a mechanism to create more demand for Treasuries from the banking system. So I see his comments as an effort to kind of address this much bigger concern for the markets and the economy more broadly.
Yeah, and I might word it a little differently. I might say they actually turned left when they should have turned right.
Yes, that is correct.
Exactly. You're part of the jobs panel coming up. We got all hands on deck with the jobs panel after the break. Stephanie will be there. Stephanie, hold on. We'll be right back. Stay with us.